Welcome to Commerce class. Now we are going to see about the scope of financial market. That is to say then what are the various sectors in which financial market plays a major role. Okay, so if you see like that, it is almost covering every sector, let it be individuals or agricultural sector, to do all type of agricultural activity, right from buying the seed or pesticide or maintaining the land or for cultivation, anything. Okay, they required fund. Similarly, industrial sector, maybe to start one or maybe to expand the existing one or to go for or for any other work. It can be service sector like transportation or warehousing, anything of such service nature. Then financial institutions, maybe bank, insurance. So and the government also, they all require the fund which they get it through this financial market. So what happens when the fund they require is got through the financial market? It leads to an overall economic development. So this is the scope of the Indian financial market. Fund is required in each and every sector, right from individual to the government. Okay, so this is the scope of the Indian financial market. Next, we are going to see the types of financial market. There are different kinds of financial market. So we are going to see it under different headings. Okay, first one we are going to see it on the basis of type of financial claim. Okay, there are two types. First one is the debt market. First one is the debt market, where debt instruments, like instruments here refers to this government bonds or securities or corporate debentures or bonds. Okay, so here this debentures we've already learned in 11th standard. Let us just recall. If you have invested in debenture, your position is that of a creditor. Your returns will be in the form of interest, only interest which is fixed. Whereas if you have invested in shares of a particular company, then your position is that of a proprietor. We can say, I mean, your your extent is to the value of the shares that you hold. Okay, so this is the difference between a debt market and a equity market. You are the owner to the value of the shares that you hold. So based on types of financial claim, you have two market, that is a debt market and the equity market. In debt market, the instruments are bonds and corporate debentures. Equity market, it is the equity shares of company. Next one, maturity, on the basis of maturity. Here you have the money market and the capital market. Usually the money market is for a short-term financial claim. Okay, your claim can be only for a short term, that is less than a year, maybe 1 year or less than 1 year. So what are the instruments traded here? It is a treasury bill, commercial paper and certificate of deposit. So these are the instruments in money market. Okay. Next, capital market. Capital market, your claim can be for more than a year. Okay. So the instruments here traded are shares and debentures. We already saw this. Shares and debentures. That is the equity market, you have the shares, and debt market, you have the debentures. That's based on the financial claim. Here we see based on maturity. Financial claim based on maturity. Next one, based on time of issue, when they issue this. Time of issue of financial claim. The first one is, two types are there. One is a primary market and the another one is the secondary market. Now as such, this primary market is a term which is used to say that when the company issues the security for the first time, then you call that as a primary market, because the money from the investor goes directly to the issuers. Okay, because there is no particular place where you can buy this particular security, no, nothing like that. So primary market refers to the act of selling the security by the issuer directly to the investors. Second one is the secondary market. Here, all those securities that were traded in the primary market are bought or sold in the secondary market. Okay, so here you have a particular place, maybe we can tell that as a stock exchange. So in stock exchange, all those securities traded in the primary market are bought and sold here, are traded here in the secondary market. Okay, so this is on the basis of time of issue, when they are issuing the financial claim. Primary market, secondary market. This is primary market. First time the company issues the securities, directly it goes to the hands of the investors. So it is called primary market. Secondary market, ஏற்கனவே வாங்கின இந்த இன்வெஸ்டர்ஸ் எல்லாமே வாங்கினது திருப்பி விற்கணும்னு நினைக்கும் போது விற்கிறாங்க இல்லையா செகண்ட் டைம், அது பேர் தான் செகண்டரி மார்க்கெட். Next we go on the basis of timing of delivery of financial claim. Once again, timing of delivery, when they hand it over. Two types, cash or spot market. Next, forward or future market. Cash or spot market. In this, the delivery of the financial instrument or the payment, it takes place immediately. One side you give the instrument, the other side you get your cash. Immediate exchange of instrument and cash takes place immediately. Settlement is completed that particular time itself. But in forward or future market, the settlement takes place on a future date. That is a predetermined time or sometime later. Immediately the settlement will not take place. Okay, so delivery of the asset and payment of the cash takes place at predetermined time in future, not now. Immediate and they will never exchange it. So based on the time of delivery, it is cash or spot market. Immediately settlement is done. Forward or future market, the settlement takes place at a predetermined time in future. Next, on the basis of organizational structure. Organizational structure of the financial market. Two types. One is exchange traded market. The other is over the counter market. Now, exchange traded market means there is a centralized place or set of procedures that must be followed for exchanging these securities. Example, stock exchange. That is a place where you can exchange your securities. But another one, over the counter market, it is not like that. You don't have a particular place. It can be over the phone also. You just give a call and you tell them. Okay, so this is how it takes over the counter market. Clear? So these are the various types of financial market. First one, on the basis of claim. Claim is a debt market and equity market. Second one, based on maturity, money market for short period and capital market for more than a year. Then basis of issue, primary market, first time issue, no place for that but buying that particular security. Secondary market, that you have a particular place like stock exchange. Security traded in the primary market only come to the secondary market. Next, timing of delivery, cash or spot. Immediately there is an exchange of the security for the cash, so you call it as cash or spot market. But forward or future market is just the opposite of it. Take place, the exchange of security and the cash takes place on a future date. Then organizational structure, exchange traded market. Here you have a stock exchange where you have some procedures followed for the exchange of securities or the instruments. But over the counter market is not like that. It is a decentralized market, so it can take place over a phone, telephone message, or through an email or something like that. Okay, this is the different types of financial market that we saw today. Thank you, children.